you have to do some judgment based on the theory of this training. Good afternoon, ladies and gentlemen. Welcome to the day 3 of this training. My name is Upai Christopher. Today we'll be discussing financial planning and bookkeeping. As you all know, bookkeeping, finance, or accounting is a very important aspect of this training. And this will help you to know how to manage the fund that you are seeking for. Some of you might have known me before, but some are knowing me for the first time. I'm a seasoned business incubator with over 10 years experience in inventory management, bookkeeping, accounting, auditing, data protection, and an educationist. I host HND in accounting, a postgraduate diploma in education, and a certificate program in data protection. Though that's, by the way, it's just for those of you that have not known me. Today, by the end of this session, it is expected that all of you will be able to understand financial planning activities, differentiate long-term from short-term plans, understand reasons for bookkeeping, identify bookkeeping method, record financial transaction, and balance the books. You can't run a healthy, successful business without having your books in order. It is a fact, a well-known fact to all of us. Financial planning is the plan needed for estimating the fund requirement of a business and determine the sources for the same. It essentially includes generating a financial blueprint for company's future activities. Objective of this financial planning, one, is to ensure availability of funds. What do you mean by availability of funds? To ensure that the fund for your business is sufficient and how to use the fund. Estimating the time and sources of fund. When do you need this fund? Some of you are farmers that deals with crops. Wish to know, maybe it's within January, February that I need this to enable me carry out my farming activities. Some are into poultry. Some are into fishery. When do I need this fund? Some of your businesses are seasonal business. Maybe during Christmas, I need money to do poultry to enable me sell the fowl before Christmas or during Christmas period. The next is generating capital structure. What is capital structure? This is trying to tell you the combination of debt and equity, how to fund your business. And the next is avoiding unnecessary funds. Yes, this one is very important, more especially for you, because there are some funds you need to avoid. It's not when you hear that they are giving money here, maybe you say, let me go, and the interest rate is 20%, 30%. You don't consider whether you'll be able to pay back this money. It's very important. You avoid unnecessary funds. Just like the one you are doing now, is 9% interest, which is, if you look at it very well, you know, it's very minimal. It's affordable. Are we together? Talk about the financial planning. Long-term financial planning. You consider a number of financial activities. One, propose fixed asset investment. What is fixed asset? These are assets that you use in your business, like machinery, equipment. These are fixed assets. And there are different types of fixed assets. You have machineries, equipment, building, and the rest of them. Research and development activities. You do a research on your product and how to improve on your product. Marketing and product development. This is very important because the end product of everything you are doing as a business person is to sell them out. So marketing, you know how to do marketing. You market your product. The next is capital structure. I have said something about capital structure. Where are you trying to get this money to finance your business? Is it by shareholders' contribution or you borrow money from outsiders? Are we together? The same thing with sources of financing. Where do you source your money to do your business? Right now, you're trying to source from NISA Microfinance Bank. These plans are generally supported by a series of annual budgets. Can we continue? We talk about short-term financial plan. When we are talking about short-term, we are talking about tactics to achieve a specific goal of an organization. How do I achieve this goal? A specific goal. Financial actions and the anticipated impact of those actions and typically covered a year to 2 years operating period. Non-cash, talk about cash budget. Cash budget. What is cash budget? Cash budget, it is an authorized financial framework of the anticipated revenue and expenditure of an organization. Authorized financial framework of an anticipated revenue and expenditure of an organization. The cash budget is a statement of the firm's plan inflow and inflow. That's what I mean by revenue and expenditure. Revenue is an inflow, while expenditure is an outflow. Am I communicating? It is used to estimate short-term cash requirement with particular attention to anticipated cash surplus and shortfalls. Typically, monthly budget are developed covering a year time period. Budgeting circle. Budgeting circle. Performance planning. You have to plan on how to carry out the activity. Provide a frame of reference, making references to the past years. You have been in the business for some years. You make references in your budget, make references to the past years, how it went. Investigating variation. Maybe there are discrepancies. You try to investigate to know the reasons for the discrepancies and you take corrective action. This is the implementation stage of planning. In planning, you have decision making. There's difference between decision making and decision taking. The action is a decision taking. Am I communicating? Then go back to plan again if there are differences in your planning. Can we continue? We talk about strategy, planning, and budget. What is strategy? goal of an organization, what the short run is the specific goal, titles, to achieve the specific goal of an organization. Don't talk about budget. Just as I said before, that budget is running is the cash budget is the authorized financial framework of the anticipated revenue and expenditure of an organization. Budget will try to tell you how to source for your money, where to source for the money, and where are you going to spend this money. We have long-run budget and short-run budget. Short-run are budget within 12 months, while long-run budget are budget that exceed 12 months. Are we together? Can we continue? Okay. Circle of money. What do you mean by circle of money? Okay, now you want to source for this money. The first step is to undergo a training. After training, the next is application for the money. After the application, the next is the money it has been granted to you for a business. Once the money is granted, you go into business. From business, you make sales from the business. What again, after sales, to pay back the money that is given to you. This is a circle of money. The primary function of finance is the movement of money from lenders to borrowers. You are now a borrower trying to access this fund from NISA Microfinance Bank. And for you to access this fund, you have to undergo a training. After the training, you apply for the money. After which, the money is granted to you. You go into business, make income. From your income, you pay back the money. This is circle of money. So we say the primary function of finance is the movement of money from lenders to borrowers and back again. Paying back the money is now said you are not paying back the money. This is referred as a circle of money. Am I communicating? Okay, that takes us to the next section of this. What is bookkeeping? Bookkeeping. What is bookkeeping? It's the recording phase of accounting. There is the first step of accounting. Bookkeeping is the first stage of accounting. Some of you may be thinking when you hear bookkeeping is to carry book and keep on the table on your shelf. It's not bookkeeping. Bookkeeping is all about recording to document transactions. So bookkeeping involves the recording. As I said, is the recording phase of accounting on a daily basis of a company financial transaction. With proper bookkeeping, companies are able to track all information on its books to make key operating, investing, and financing decisions. This operating, investing, and financing decision is all about cash flow. In today's session, we'll be discussing debit and credit, income and expenditure. That is revenue and expenditure. Bookkeepers are individuals who manage all financial data for companies. Am I communicating? Individuals who manage all financial data for companies are bookkeepers. Without bookkeepers, companies will not be aware of their current financial position. That will be taking us to the balance sheet. When we are talking of the financial position of an organization, we are talking about the balance sheet. We'll get there. As well as the transaction that occur within the company. If you are not recording your transaction, you will not be able to ascertain the position of your business at any point in time. So you need bookkeepers. Before you talk of accountants, you have to keep the record before you talk of accounting for it. Am I communicating? Importance of bookkeeping. One, it measures company's performance. It measures company performance. As I said, when I'm talking about company performance, it's in the balance sheet, you see the performance of a company. The balance sheet will tell you whether the company is doing well. It's in the balance sheet, you see the assets, you see the liability and equity. So balance sheet is very important in accounting, in every business, for you to know the performance of your company. Am I communicating? Now the next is it provides information for strategic decision. I told you that strategy is to achieve the overall goal of an organization. So it provides information on how you achieve the overall goal of an organization. It provides benchmark for revenue and income goals. Income is an inflow, as I said. Just the same with income and revenue is an inflow to an organization. The next is fulfillment of legal and tax obligation. It helps you to know and understand actually how much to pay as your tax. If you are not keeping record, you cannot ascertain what to pay as tax, payee, company income tax, and the rest of them. It provides stewardship to investors. What is stewardship accounting? In accounting, there's what is called stewardship. Stewardship is trying to account for everything that is given to you. Accountability. So account how the money that was entrusted to you was used in and out. Am I communicating? That's accounting for stewardship to investors. Who are the investors? They are creditors. People you are buying goods from. People that are sponsoring your business. Are we together? It helps you to maintain a proper management of cash flow. Cash flow is all about movement of cash in and out. The money coming into your organization and the money going out. Bookkeeping helps you to know and manage the cash flow statements. Accounting basis. We now talk about the accounting basis. There are basically two methods of accounting. We talk about cash basis, we talk about accrual basis. What is cash basis? Cash basis record transaction only when cash is actually received or paid. For example, you went to buy a computer and you bought it on credit. As a company, at that point, you were supposed to record your transaction. You are buying this on credit. But cash basis is telling you that you will not record it until the day you are paying the cash. That's when you record the transaction. Why accrual basis is trying to tell you that you recognize every expenses or revenue at that point, whether it's on credit or cash. Record transaction when it occurs, even if cash is not received or paid. That's accrual basis. And this is as the accepted accounting basis in accounting. Accrual basis is only accepted accounting basis in accounting. You record your transaction as at when it occurs. You purchase 100, for example, you purchase 100 units of a product and we pay for it next month. Cash basis say no transaction is recorded because you bought it on credit, no cash, money did not exchange hand. That's what cash basis is trying to say. But accrual is telling that transaction recorded through an account, payable, liability account. Are you there? You record that you are owing people this so amount. Am I communicating? Are we together? Okay. Method of bookkeeping. Method of bookkeeping. Single entry bookkeeping. We have single entry bookkeeping and we have double entry bookkeeping. Single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. What do you mean by that? You have a book that you are recording expenses. You have another one that you are recording income, revenue. That's single entering bookkeeping. You maintain debit different and maintain credit different. The next is double entering bookkeeping. Double entering bookkeeping is more robust. It follows the principle that every transaction affects at least two accounts and they are recorded as debit and credit. Yes, this is when the basic principle of accounting. There's what is called basic principle of accounting, which say that in every transaction, there must be, in every debit transaction, there must be a corresponding credit entry. Are we together? That is debit cash and credit sales. If you sell a bag of cowpea for 20,000, the entrance is you debit cash and you credit sales. You have received the money. Then you credit sales that you have made sales. So some goods has gone out of stock. That's debit cash and credit sales. Are we together? Can we continue? Are you there? Now talk about accounting systems. Accounting system is very important. Accounting systems. It is designed to correct, document, and report on financial transactions affecting business. We have manual accounting system and we have computerized accounting system. The manual accounting system is processed by hand, which the former is not the current trade now. Processing everything by hand. That is manual accounting system. We talk about computerized system. Financial information is recorded by entering it into computer. This when we talk about the accounting softwares. Some of you maybe are accountant, you know about accounting software. You have Peachtree, you have Sage, you have QuickBook, and the rest of them. That's what we mean by computerized system. You use software to do your accounting. Are we communicating? Bookkeeping with and without a computer program. Why do you need to know that since there are so many computer programs out there you can use? Yes, bookkeeping without computer will not help you anymore because you may not be able to find it more easier to do your account. Have you heard the saying garbage Okay. Welcome back. Sorry for the interruption due to network. So I was saying something about garbage in, garbage out. Say what you give to a computer, that's what computer will generate and give you back. If you post wrongly, computer will generate wrong information and you get wrong information. You have to understand the basic bookkeeping behind what you enter into the computer program in order to enter in the correct information. Now talk about accounting system. GAAP. What is GAAP? What is GAAP? Generally accepted accounting principle. This is a basic principle used by all accountants in preparing financial statements. All accountants use the same set of rules to prepare financial reports. The Financial Regulatory Council issued these rules. Financial report is a summarized information about the financial status of a business. That's financial report. Financial, we talk about language of business, which is accounting. Language of business is accounting. Are we together? Because it is so fundamental to the communication of financial information, accounting is often called the language of business. Because in every business you are doing, you're about account, money exchanging hand, money coming in, money going out. Are we together? Financial accounting. What is financial accounting? Financial accounting focuses on reporting information to external users. And who are the external users? Government is an external user of financial accounts, financial statements. Creditors are external users of financial statements. And the rest of them, we'll discuss that in full. Management accounting is reporting to the management, internal users of financial information. That's management accounting. It focuses on reporting information to management, often referred to as accounting for internal users of accounting information. Am I communicating? Who uses accounting information? Who are the users, as I said? For informed decisions, individuals outside the business who have an interest in the business, like stakeholders, they have interest in the business. And I told you, government, general public, civil societies, and vendors. There are different reasons why all these people are interested in your financial information. The government is interested in your financial information so that they will be able to ascertain what you pay as tax. General public, they want to know whether your business is a going concern. What's the going concern? Whether your business will continue to exist in the nearest future. Civil societies, the same thing, to ascertain the status of your business, whether your business is doing well. And render, who are the renders? The bank, like now, microfinance. You are trying to access this money from them. They are interested in your financial statement so that they will know the status of your financial statement, whether you will be able to exist in the nearest future. That's going concern, and whether you will not, if you are seeing your business that you cannot exist, you cannot function in the near future, they will not see it possible to give you the money. That's why they are interested in your financial statement, so that they will ascertain and know whether this money will be paid back as at when due. We talk about the individuals inside the business. Who are the individuals? Stakeholders. Stakeholders. The shareholders of the organization. The owners of the business are the shareholders. They are interested whether they are making profit, whether the business is making profit, generating income. That's why they are interested in the financial statement. The managers, the employees, these people are interested whether the business is doing well, so that they will ask and request for a more take home to request for an increment in their take home. Am I communicating? That's why the managers and the employees are interested in the financial statement, and these are the insiders. Can we continue? Primary accounting report. We are now going to balance sheet, income statement, and cash flow. And as I have mentioned balance sheet before, now you know the meaning, the full meaning of balance sheet. Balance sheet currently is called statement of financial position. Statement of financial position. This will help you to know the status of your business, to know whether your business is doing well or not. Balance sheet will help you to know. What you have and own, asset and liability will give you equity. It's in the balance sheet that you see assets, equity, and liability. What is an asset? A resources controlled by an organization. What is owned? The equipment, the cash, everything owned by the organization is an asset. A resources controlled by an organization. What is liability? It's a present obligation. What you are owing people, the debt you are owing people. I will talk about the equity. Equity is a residual value shareholders fund. It's after assets, in minor liability. That's when you have equity. What the shareholders can share, shareholders fund. That's why I said liability plus equity is equals asset. Asset minus liability have equity. Am I communicating? Liability plus equity have asset. Asset minus liability have equity. You minus what you are owing people from what you have. You have equity. That's shareholders fund. Residual value, what the shareholders can share among themselves. Am I communicating? Now go to income statement. Income statement is in the income statement that you recognize the revenue, the income, sales, and the expenses of an organization. An income statement will show you the inflow and outflow, how you generated the money and how you spent the money. That is in the income statement. You see the expenses for the period and the revenue for the period. You see all these things in the income statement. How much you make, which is sales minus expenses, will give you income. Your sales minus expenses will give you income. Am I communicating? We talk about the cash flow statement. Cash flow statement is all about movement of money in and out. Movement of money, cash in and out. From where did you get this money? From where did you put this money? Cash flow, what is the liquidity position of the company? Cash flow, cash inflow minus cash outflow, give you cash and cash equivalent. Can we continue? This is a typical example of balance sheet. As I said, balance sheet is asset. Asset is equals liability plus equity. Why equity? Liability is asset minus equity is asset minus liability. Am I communicating? If you look at the drawings, you see asset is having a full page. Why liability and equity is sharing a page? Am I communicating? So asset minus liability will have equity. Equity is having, that's why I say equity is a residual value. Equity is having a very minor size of the page. It's showing that it's after removing what you are owing people, which is liability, what you are owing outsiders. What is remaining is the equity, what the shareholders can share. Am I communicating? Hope we are together. We talk about the income. This is a two-year drawing of income statement. The revenue must be bigger than the expense and profit. The revenue minus, which is sales minus expenses, you have profit. When you minus your expenses from sales, you have profit. Hope I'm communicating. Okay, we'll continue. This is a typical example of balance sheet. In the balance sheet, you have assets, liability, and equity. And I have told you what an asset is. An asset is a resource controlled by an organization. These are typical example of asset: cash and cash equivalent. The cash, the money you have in the bank, is an asset. You can use it for the organization. Account receivable. What do you mean by account receivable? Debtors. Debtors are account receivable. It's an asset to an organization. Those people owing you, they're an asset to an organization. Inventories. What you have in stock is inventory. It's an asset. These are current assets. It's an asset to prepaid expenses. What do you mean by prepaid expenses? Prepaid rent. Some of you will pay your rent on annual basis. It's a prepaid expenses. You paid in advance. Am I communicating? Investment. These are current assets. Not talk about the non-current asset. It's in the non-current that we'll be talking about property and equipment. We are machineries, one building, equipment. Are you there? Your buildings are a non-current asset. Your land is a non-current asset. Equipment is a non-current asset. Where's depreciation? Am I communicating? Other asset, intangible asset. What do you mean by intangible assets? Some of you have been in business, and maybe in the process you decided to say your business out. You say it with goodwill. Maybe your business has been doing well. You say it with goodwill. Goodwill is an example of intangible asset. Maybe your business worth 5,000. Because of the goodwill of your business, you put additional 2,000, making it 7,000. It's an intangible asset. Am I communicating? Then we talk about the liability and shareholders' equity. I've told you what liability is all about. It's a present obligation. The money you are owing people. What you are owing people is liability, present obligation. That's what we mean. You talk about account payable, note payable. All these people are your creditors. Payables are your creditors, people you are owing. That will take me down to this explanation. Some of you are making mistake and say, don't you know I'm a creditor? Taking it in the other way around as debtors. You are not a creditor. Is the person you are owing is a creditor to you. The person you are owing is a creditor. You that is owing that person is a debtor. Am I communicating? And that's what is called account payable. These are your creditors, people you are owing. We talk about accrued expenses. What is accrued expenses? And accrued expenses, these are expenses that you have incurred, but you have not paid for the expenses. Maybe you have been using somebody's building as an office. Your rent is due and you have not paid the rent. It's an accrued expenses. You have not paid, but you have consumed, you have used the house, your office, but you have not paid. It is called accrued expenses in your accounting. Deferred revenue. What is deferred revenue? Just in the same way, maybe you have paid for your rent, or someone has paid, you own a house, someone has paid for the rent in advance for next year. It's a deferred revenue. You have the money has been paid to you, but the person in question has not used the rent. Am I communicating? Can we continue? That will take us to shareholders' equity. I have defined what is an asset, liability, and equity. And I said an equity is a residual value. Shareholders' fund. Shareholders' fund. We have common stock. That is share capital. Additional paid-in capital. That additional money brought in by the shareholder within the year, within the period. That additional paid-in capital. Retained earnings. These are your profits for the past years. Accumulated profit. It might be profit, it might be loss, but this accumulated profit. We talk about the treasury stock. Treasury stock, you issue stock. Stock you sold up. Maybe you have sold part of the shares of your company. That's treasury stock. You issue stock. Am I communicating? Can we continue? Okay. Now move to income statement. We have discussed balance sheet and we mentioned assets, liability, and equity in balance sheet. Now we will now discuss income statement. In the income statement, you will recognize your sales and expenses. These are the two elements of accounting you see in the income statement. Sales. What made up your sales? Your sales is those things you sold out. Maybe you are into fishery. Those fish, when they are matured, you harvest them. Use the word harvest in fishery business. When they are matured, you want to sell them, say you are harvesting your fish. These are your sales. Ground service, maybe you are rendering service, just as we are doing here. Professional book sales, if you are into books, selling of books. Professional consultation, just as we are doing, we are your consultant. Some of you are already consulting for you. These are your sales. Like now, in our own side, we recognize the money you paid as professional consultation, as sales. It's an income to us. The money you pay for the training. Am I communicating? You talk about the expenses. You have direct and indirect expenses. Expenses incur in the process of getting those goods. Wages, what you pay your workers. That reminds me. For example, some of you have found the habit of not paying yourself as the owner of the business. At the end, you'll be shouting, I made profit of 1.2, 1.5. But you have forgotten that you did not pay yourself. Some of you are using your homes as your office. You have forgotten you have not paid your rent. You didn't deduct your rent from the income you made. Sometimes so many business people, they keep incomplete record because of all this. You don't recognize the money you're supposed to pay yourself. You don't recognize the rent you are paying because you are using your house as your office. You don't recognize your rent. It's wrong. When you factor all these things in your accounting, that's when you understand very well whether you are making profit or not. Am I communicating? This is very important. If you fix yourself on monthly, so that every month you pay yourself 100,000. In a year, you have paid yourself 1.2. When you remove that money, that's when you know the real state of your business. Can we continue? Marketing and advertising is an expenses incurred. The money you pay radio house, you go to newspaper and publish your product. You go to radio, you go to television and the rest of them to advertise your product. It's an expenses incurred by the organization. Rent, as I said, these are wages and rent. This way some shareholders, they make mistake. They don't pay themselves. You fix yourself and they rent. Maybe you're using your building, you own a house, you're using your building as your office. You factor in the rent. You're paying rent 1.5, you factor in the rent. So you can determine what actually is the profit at the end of the year. Am I communicating? Can I continue? You talk about the utilities, NEPA bill, water bill, all those things. Some just put hand in the pocket, remove money and pay. They don't record it. These are expenses incurred by organization. You have to record all those things. They say your utility bill, your water bill is 1,000, 5,000. You just put hand in the pocket and pay. No record showing all those expenses. Memberships and publications. Some are members of organizations, your trade unions, and the rest of them. All those your membership bills, membership fees that you pay, all these are expenses in the course of your business. Insurance is an expense. Consultant is an expense. Money you pay to your consultant. Right now, you have paid for this training. You record it in your expense book. Consultants fee, so amount. Office supplies like your stationaries and other things. Biros, you buy biros, buy a sort of office supplies. You record them. These are expenses. When you are not keeping all these things, not recording all these things, you are keeping incomplete record. Maybe you record one side, you didn't record other ones. It's incomplete record. You are not paying yourself, you are using your house as your office. You are not factoring the rent. It's incomplete record. You need to keep, that's when you know actually whether you are making profit. That's the truth and nothing but the truth. Can we continue? Talk about the you talk about the operating income from other businesses, interest income. Some clients in their bank pay you interest. More especially for those that are using savings account. Some months you see interest income. They will credit your account with a small amount of money. All these are interest income. What's on sales of asset? Maybe you sold your asset, you bought your asset 1 million naira and sold it 800,000. You record 200 as a loss in the sales of the asset. Am I communicating? Donations. Donations is an expense. You make donations in the church, in the orphanage, and the rest of them. As a CSR, what is CSR? Corporate social responsibility. Maybe even around where you are operating. It's very important. Donation is very important to some organizations. Maybe you are into poultry and your farm is where people are staying there, is disturbing them. How do you pay them or make them not to come back? Because they will be coming to you. This is your family disturbing us. This is your family disturbing us. But if you're making some donations to the community, that is a corporate social responsibility. If you're making donation, maybe you give some of their children scholarship for them to come. They are benefiting from you then. They will not disturb you too much. Some are into fishery, the fish pond is disturbing them within the environment. What do? Maybe you have borehole, you have to extend the borehole to your neighbors around. That will calm them down. Because actually the water maybe is disturbing them. And if not, if you are not doing all these things, they will start petitioning, writing up and down, causing havoc in your business. Some even go to the extent of poisoning your pond. Since you don't want to stop this fish pond here and it's disturbing us, they will poison you, not know where they will put poison in your pond, and now your fishes, they will die. But if we are giving them, making donations, rendering CSR, corporate social responsibility, assisting them, they will calm down because they will know they are actually benefiting from you. They will not go to that extent of poisoning your pond. Am I communicating? It's an expenses incurred. Can we continue? So provision for income tax, you pay your tax. We have discussed about the external users of financial statement. We say government uses FIRS to get that tax from you. We go to the next component of accounts. What are the components of accounts? The basic unit of accounting is an account or general ledger account. It is a unit of information that represents business record. There are 5 types of accounts. That's when we talk about element of accounting. 5 types of element of accounting. We have already discussed them all. Assets is an element in accounting. Liability is an element. Equity, revenue, and expenses. And I have told you what an asset is all about. An asset is a resources controlled by an organization. Liability is a present obligation. What you are owing people. It's an obligation, you pay this money back. Just as you are trying to access this money for NISA. Once it's given to you, it becomes an obligation to pay back this money. Let me tell you, sincerely speaking, this is not grant. Have it at the back of your mind. It's not like this month, that's why some people, when they go for an interview, they will not do well when the NISA call for interview, because you had at the back of your mind, you're not going to pay back this money. Coming and ask you, how do you pay back this money? You don't know what to answer because before coming, you have made up your mind that you don't want to pay back this money. But if you are prepared to pay back this money, you tell them you pay back for your income, from what you made for your business. That's your income. So I want you to be aware that this money, once it's accessed, you must pay back. It is a must, it's an obligation. You pay back the money. Am I communicating? That's liability. By that you are owing as a microfinance bank, so amount. Equity. These are residual value, as I said, shareholders fund. Equity is shareholders fund. Revenue. This is an increase as an inflow to an organization. Increase. The money coming into an organization is revenue. Expenses is a decrease as an outflow to an organization. Money going out of the organization. That's expenses. Am I communicating? These are the 5 elements of accounting. A business can have anywhere from a dozen to several thousands. Can we continue? Accounting. What is accounting? We have been discussing bookkeeping, and I told you bookkeeping is the first phase in accounting. Now we are talking about accounting. Bookkeeping is the first phase in accounting. It's all about recording of transactions. Recording. That's the first phase in accounting. Recording of transactions. Now we're talking about accounting. Accounting is an art of recording, summarizing, analyzing of financial statement to the users of that financial statement. That's accounting. It's an art of recording, analyzing, summarizing, classifying. Am I communicating? Of financial statement, of financial transaction to the users. Accounting is a process of recording business activities that make changes to account. This includes sales of product, your sales, your revenue. What I'm talking about, you're talking about revenue. Your revenue. Buying product, your cost of sales. Cost of sales, what you spend to get those things before you sold them. Maybe you're into fishery, you bought feed, you bought fingerlings before they mature, you harvest them. These are your buying products and services. What you spend, incurring other expenses. Yes, other expenses, like your rent, wages, utility bills, and other things. Depreciation of fixed assets. Yes, depreciation. This, for example, let me tell you what depreciation is all about. You have a motor vehicle you use for your business. That motor vehicle is serving you for the business. Maybe you say every year you depreciate that business, that motor vehicle by 20%. Remove 20% of the worth of that motor vehicle as an expenses in your business. That's depreciation. Am I communicating? Remove 20% of the worth of that car as depreciation on an annual basis. Closing books for the year. This is about your inventories, preparing your financial statement for the year. That you close your accounting book for the year. Then, when any of these and other businesses activities are recorded, account change in value, which is true. Are we together? Go to double entering accounting. We mentioned double entering bookkeeping. Now we're talking about double entering accounting. That is when we discuss about the basic principle of accounting, the accounting principle, the basic principle of accounting. That say that in every debit entry, there must be a corresponding credit entry. This in and out. The money coming in, money going out. Am I communicating? For any business transaction that happens, 2 or more accounts are affected. There is a give and take of equal naira amounts. Am I communicating? This is called double entering accounting. There are 2 types of actions done to account to bring the value up or down. The actions are called debit and credit. Now we'll be discussing about debit and credit, and we have been discussing it using other terms when we're discussing inflow and outflow. revenue and expenditure is all about debit and credit. Am I communicating? Whether an account grows or shrinks when it is debited or credited depends on the account. Yes. For an account to grow, for an asset to grow, you debit an asset account. For an expenses account to grow, you debit an expenses account. For a liability account to grow, you credit it. For an income to grow, you credit it. Am I communicating? So a debit to an asset account makes it bigger. Yes. Do you want to know why? You want to know why? Say, for example, you bought motor vehicle, you debited that you have gotten this motor vehicle. You went and purchased computer and other furnitures. That's an additional, the asset account is growing where you are debiting it and it's growing. It's an example. So a debit to an asset account makes it bigger, but a debit to a liability account makes it small. Yes, you bought goods for your creditors. You didn't pay. They recorded that you are owing them 500,000, for example. They credited the account that you are owing them. Then, when you assume, for example, that you paid 200,000 or 300,000 within that period, they will debit it to reduce what you are owing. That's what I mean by to debit to a liability, make a liability account makes it smaller. The opposite applies when crediting. Crediting an asset makes it smaller, and crediting a liability makes it bigger. Am I communicating? The next is a debit to a revenue account. A debit to a revenue account makes it smaller, and debit to an expense account makes it bigger. A credit to a revenue account makes it bigger, and credit to expense makes it smaller. For equity, it gets bigger when it is credited and smaller when it is debited. A record entry that has debits and credit is called a journal entry. Am I communicating? Are we together? Are we together? We talk about debit and credit or account to get. Are you there? To make an account go up, get bigger, in the balance sheet, you debit an asset. If you debit an asset, you are increasing the worth of the asset. When you credit a liability or equity, you are reduced for the account to, you are increasing the what you are owing people. Say, for example, you were owing people 500,000 and you added 200,000 in the credit. You are increasing what you are owing people. The same thing in the equity. Then we'll talk about the income statement. When you credit revenue, you are increasing your sales. Debit expenses, you are increasing what you spend to make that revenue. Are we together? And we continue. If you have any question, reserve it. Very soon you ask your questions. We talk about to make an account go down, get smaller. In the balance sheet, you credit an asset. When you credit an asset account, it reduces the worth of the asset. When you debit liability, it reduces the worth of what you are owing people. That means you have paid back some of what you are owing people. Talk about the income statement. If you debit revenue, you are reducing your income. If you credit expenses, you are reducing what you spend to generate that money. Are you there? With this, we'll come to the end of this accounting, bookkeeping, and financial planning. If you have any question, you can ask from what we have discussed so far. Thank you very much.
Good evening, sir.
Good evening, you're welcome.
Yes, sir. This is I was calling from Niger State.
Okay, Mr. Ghana, you are welcome, Mr. Ghana.
Yes, sir. But please, I want a clear differences between income and expenditure and cash flow.
Sorry, I cannot hear you. Come back.
Income statement.
Yes.
The clear differences between income statement and cash flow.
Okay. Are you there? Any other question? Any other question from you, Mr. Ghana? Okay, you are welcome. Income statement, as I said, is when you recognize your sales and expenses. Am I communicating? Income statement is where you recognize your sales, your revenue, and your expenses, what you spend, your cost of sales, what you spend to generate that money. That's what we recognize in the income statement. What you your sales, what you generated, and your expenses. Am I communicating? It's in the income statement. Am I communicating? Am I communicating? You recognize them as sales, whether credit or cash sales. You recognize them in your income statement as sales, whether it's cash or credit. Am I communicating? Am I communicating? That is the meaning of income statement. But when you talk about the cash flow statement, you are recognizing cash, only cash movement, cash, money exchanging hand, money coming in and money going out. That's the difference between income statement and cash flow statement. In your income statement, you recognize whether money is paid or not, whether your customers bought those goods on credit. Once you have given them, it's an income, recorded as sales. But in the cash statement, in the cash flow statement, it's only cash movement. The money going out from you and the money coming in. That's what you recognize in your cash flow statement. Am I communicating? Are you okay? Hello, Mr. Ghana? Cannot hear you. Network. I'm not hearing anything. I'm not hearing anything. Oh, Mr. Ghana? Oh, Mr. Ghana?
Yes, sir.
Okay, I can hear you now,
clear.
Mr. Ghana.
Yes, I'm clear. Thank you so much.
You are better now. You are welcome.
Yes, sir.
Any other question from any other participants? If you have any question, you ask concerning what you have done or beyond what you have done. If you have any question, you ask concerning the exercise. Not hear anything. I'll ask whether there's anybody ask question. Somebody is talking. Any other question? If there's any other question, you can ask your question. Ask your question now. You have all the opportunity to ask your question. Madam Maria, any question from you?
No.
Any question? I know you will not ask two more questions because I think you are an accountant. I'm thinking so. Oh, Madam Maria, no question? Mr.
No
Donatus.
question, sir. All cleared.
Welcome. Mr. Donatus Abba and Dr. Ariko Emmanuel. Any questions? Okay, if there's no other question, we'll come to the end of this session of we come to the end of this session of financial planning and bookkeeping. As I said, it's very important you maintain books of account. Maintain proper books of account. It will help you not only in what you are trying to pursue now, but in all your businesses. If you are pursuing to have accounting software, you install accounting software to enable you do your accounting very well. So you'll be expecting the post-quiz. Some of you did not attempt the pre-quiz before this training. Please attempt the post-quiz and screenshot and send back to us on the WhatsApp platform. All these things matters as far as this training is concerned. Thank you very much.